Hello fellow traders and welcome to the Max Beep. In this video we're going to be talking about the failed engulf theory, the failed engulf strategy. Some of us might know about it, some of us may not. But at the end of this video you're going to learn what an engulf is, type and patterns of engulfing, and when an engulf candle is failed, and the formula for the failed engulf setup, and then we'll move to the chart. Most of us already know what an engulf is, but for the sake of this video, the definition of an engulf candle is when there are two candle price pattern, and when the second candle completely engulfs and covers the body of the first candle, as in this case here. And there are two type of engulfing candle. We have the bullish engulfing. That's when the bullish candle is the engulfer. So the bullish candle is the bigger candle, and the bearish engulfing is when the bearish candle is the engulfer, which signifies price going down. I'm going to drop this document. I'm going to drop this document in the Telegram group. So if you're interested in it, just hit the link in the description below. So we have bullish and we have the bearish engulfing candlestick. So when is an engulf failed? An engulfing pattern is failed when an engulfing pattern is then engulfed. So when there's an engulfing candlestick and that engulfing candlestick is then being engulfed by another candlestick or by a set of candlesticks, then that is a failed engulf. We're going to see more of that when we go to the chart. And the formula for the failed engulf setup is, first of all, you go on your higher time frame to spot a failed engulf. And for this video we're using H4 for our higher time frame. Spot a failed engulf on your higher time frame. Then you wait for a reverse from that failed engulf back into the zone that the price broke out from. And once price have reversed into that zone, you're going to wait for multiple consecutive 30 minutes candlestick being engulfed. We're using 30 minutes for our smaller time frame. You can, once you learn the setup, you can actually tweak it and use whichever you think is right after back testing, whichever time frame you think is right after back testing. But for the sake of this, we're going to be using H4 as our higher time frame and 30 minutes as our lower time frame. So with that being said, let's head to the chart. Our example is going to be 19th, 21st and 23rd of your years of January. So let's 1 second, just have to clear this cloud tab. Yeah, so we're on our H4 time frame. We'll look at the 19th. Okay, here we can spot our failed engulf. I think this is on the 16th. Yeah. So on the 15th of January, we can see a bearish engulf here. We can also see a bearish engulf here. And we can then see that these two bearish engulf, price went back up and engulfed both of them. Once price closed above these two bearish engulf, then we can now conclude that that is a successful failed engulf. So I'm going to put the horizontal line. So this green candle here signifies price closing above these two bearish engulfs. So therefore we have the first part of our setup have been fulfilled, as we've spotted our higher time frame failed engulf, so which is on this green candlestick. So we're going to wait for a reverse back into the zone that price broke out from. Now any zone below this horizontal line is where price broke out from, because price broke out from here. So any zone from here, this point here, to this horizontal line, that is the zone. So first step, identify high time frame engulf, done. Wait for price to reverse into the zone it broke out from. So we're going to wait for price to go back into the zone, which it did on this candlestick, and then we're going to wait for the origin of multiple 30 minutes consecutive candlesticks to be engulfed. So let's go down to our 30 minutes so I can explain that better. I think that was okay, yeah, that's the 19th of January. So we have to wait to see at least, let's say, more than two. Let's say two or more 30 minutes consecutive candles that is later engulfed. And we can see here that price, make this bigger, we can see here that price, after price moved into the zone, we can notice there are multiple consecutive means that there should be no interruption. It shouldn't be like red green. It should be just, for this example, it should be red. So you're going to wait for 30 minutes consecutive candles to be engulfed. So once you see this, we're going to wait for this set of candles here to be engulfed. And as soon as this set of candles are engulfed, our trade is set. We can now take our trade. And this is a point where our candle, where the 30 minutes consecutive candles got engulfed by this candlestick. So from there our trade is set, and we can now successfully take our trade as soon as it gets engulfed. Our trade is set. You put your stop loss below the initial low, and then you can trade it 1:2. In this case, we got a, let's say, 1:3, 1:3.5. We could have extended it to 1:4. So that's our first example. So let's go back to a higher time frame and see if we can spot another example. I think our second example should be on the 23rd of January. I'm trying to use very recent examples. And take this off now. So we can see here also that on the 21st of January there's also a bearish engulf here, and from this point we see that this bearish engulf, price went up and broke this bearish engulf. This is the 21st of January. Price, and so this bearish engulf has been successfully engulfed. That is, we can now call this bearish engulf a failed bearish engulf. And this candlestick here is the candlestick that closed. The candlestick must close above the bearish engulf before you call it a failed bearish engulf. So that's the first part, identify higher time frame failed engulf. Then second part, you wait for price to reverse into the zone it broke out from. Now remember what I said, any zone below the horizontal line is the zone that price just broke out from. So wait for price to go back into it, and then we'll wait for the origin of multiple 30 minutes consecutive candlestick to be engulfed. So let's go down to our 30 minutes time frame. This is 22nd of January. Twenty-second of January. Yeah, so this 22nd of January, we'll have to wait for price to go back into this zone, and we have to wait for 30 minutes candle, multiple 30 minutes candles, in this case multiple 30 minutes bearish candles, to be engulfed. So we can see once price has entered this zone, it has printed multiple 30 minutes candles here, and here we also have two 30-minute candle. So we just have to wait for, you can either wait for these two candles, these two bearish candles to be engulfed, or you can wait for this set of bearish candles to be engulfed. But either ways, your trade will have gone your way. So you can see once these two candles, these multiple candles are engulfed successfully with this green candlestick, you can take your trade from there, and that again would have been a good trade. That again would have been a good trade. You would have taken, let's say, 1:4, 5, 6, 7. So that's the power of the failed engulf theory. Just to recap the rules. Or the formula for this setup. Come on. So the formula for this setup is, you identify a higher time frame failed engulf. In this case, we're using H4. After you identify a higher time frame failed engulf, you wait for price to reverse back into the zone that it just broke out from. Then after you reverse back into the zone, you narrow down to your 30 minutes time frame, or your smaller time frame, whichever smaller time frame you choose to use. And then you look for a situation where multiple 30 minutes candle, consecutive bearish candles are being printed. In this case, we're using bearish. It could be bullish. Just, it has to be the opposite of the direction you are looking to go for. Now in this case, we are looking to go for bullish. That's why we're looking for like 30 minutes consecutive bearish candles to be engulfed. And once you see that engulfing of 30 minutes consecutive candles, your trade is set. You can go into your trade. This is a 1:2 setup, 1:3 setup also. Sometimes I use 1:1.5 just so that I don't stay long in the trade, but it could work for either. So thank you for watching. If you gained any value in this video, then please do well to share and like and leave a comment if you have any question. We share insights like this in our Telegram group, and the link is in the description below. Thanks.